Good morning, everyone. Welcome. Welcome to the second in this four-part series of lifelong learning. We're going to take a few minutes and wait for more people to join. So in the meantime, one thing that's kind of fun is to see where you're all phoning in from, where you're all calling in from. Maybe you can just put your neighborhood if you're phoning in from San Diego. I'm here in La Mesa. Some of you may be in other parts of the state or out of state. Okay, Brett, you're from San Francisco. Welcome. So if you would go ahead and put in the chat, it's really fun to see. Pasadena, Oxnard, Los Gatos, fantastic. I love it. Little Italy, one of my favorites. Ooh, Des Moines, very nice. Somebody from Iowa here. Columbus, Las Vegas. This is really fun. And this is especially fun for our professor today, Professor Priya Garg. I'll let you know that Priya has just joined the USD faculty. She moved to San Diego over the summer, and this is her first semester with us. Priya, you joined us from the East Coast, right?
Yes, the Northeast, which is as different as it gets from the Southwest. We have a lot of rain, we have a lot of snow, we have a lot of wind, and San Diego is paradise. It is
Yes, it
absolute
is.
paradise.
Definitely. I see somebody from Connecticut
Well,
back
so
in.
I'm not envious of them, I'll put it that way.
Well, we are just so delighted to have you here at USD. I'm so happy to hear that you're enjoying San Diego. And we just got such a great response to your webinar title, Finance for Non-Financial Managers. It seems to be, a topic that a lot of people know that they need to learn about or continue to sharpen their saw, get better at. And so without further ado, would you please go ahead and begin your program? Thank you, Priya.
Sure. All right. Hi, everyone. As Bridget mentioned, my name is Priya, and I'll walk you through a little bit about finance. I mean, we have had this field since prehistoric times, so unfortunately I can't tell you everything about it in less than 45 minutes. I'm not even going to attempt to do that, but I will give you a sneak peek into the thought process of what goes on when we're making financial decisions. So let's start. Right. So I'm going to ask you a very simple rhetoric question. These are three decisions that we have here. Should I go back to school for graduate or postgraduate studies, or should I keep working? Should I get married to my current partner, even though they leave a wet towel on the bathroom floor? And that's not a good thing, to be honest. They should pick that up. And should I stay in this job where my boss calls on Sunday nights at 8 p.m. to try and, or should I try to find another employer that understands the sacredness of weekends? And I think it's more sacred in San Diego than it is in Boston. So these are like these kind of questions that we're going through in life. And this really mimics a lot of finance as well, because look at these questions. They're all about balancing risks and rewards. The first question, should I go back to school for more studies or keep working? It's a question about should I take this risk of sacrificing 2 years of my pay, maybe taking on more student debt for a chance at a better job in the future. The second one, maybe I'll find a partner that doesn't leave wet towels on the floor. There's still some hope out there. Or should I stick to this guy because, he understands being vegan is important to me? Something of that sort. Third one, I don't think we need to even, I don't think I have to even explain talking about working at 8 p.m. on a Sunday night, especially with COVID and work from home and how we have really no personal lives yet. So the idea is finance is just this, right? It's risk versus reward. And it's a continuous question that's being asked. What is going on here? So we're saying we have potential risk when we take on a project, when we take on, a small business, even a large corporation, even the government. And we're weighing these risks and rewards to manage money and resources for their financing and their continual existence. So when we talk about finances, we're saying, okay, I'm looking at a certain project, I am looking at a certain decision, and I am weighing what are the risks of taking on this decision versus not taking it on, and what are the rewards I'm going to get for this. So there's a golden rule of finance. When you take on risk and risk means uncertainty associated with future events, you must get a reward. So what we're going to do today is basically apply this to a financial situation and see how we look at, like, how do we understand risk? How do we frame risk? And let's just get started before I keep blabbering. So we're gonna have a situation here where we have a friend called Anna, and she's asking you for a loan for her ongoing business. So this is Anna, and she goes, "Hi, friend. I know we haven't caught up in a while. I have been so busy with my business." About that, actually, you know, those friends that always come up to you like, "Hey, I've been really busy with this," and about that. So that's the kind of friend Anna is. And she goes, "Do you have $10,000 that I could borrow? I promise to repay it within a year with interest." And so this is creating a unique opportunity for you to assess risk versus reward. There's risk in lending money to Anna, and there's also potential reward of getting this interest back, right? So this is the $10,000 plus a little bit more money at the end. So I'm going to open it up to you guys in the chat box. You can unmute yourself. But I'd like to ask, you know, ascertain from you, what kind of questions would we have for Anna if we had to decide whether to take on lending her this money or not? So I'll leave it up to you in the chat box, and I'll start looking at that to understand what kind of questions you would ask Anna before you'd lend her the money. Getting some chats. What will the money be spent on? Do you have sales? Okay. What are the current results of her company? Can I look at your, oh, Emily, yes, can I look at your balance sheet? What is the business? Okay, current P&L, what kind of interest rate do you have in mind? So Christian really nailed it, right? The first question is, tell me more about your business. So, okay, let's find out. What will you do with this money, Anna? And Anna goes, you know what? I have a small restaurant. We serve fusion food, think Chinese tacos and Mexican burgers. I was very hungry when I came up with this, so I think that kind of explains why I went with a restaurant model. We want to introduce pizza. Oops, sorry about that. We want to introduce pizzas in our menu next, as our customers love our quirky combinations. We need the money to buy a pizza oven. So we've gotten the business model, which is a fusion restaurant. It's a small restaurant. We have got the fact that what she wants to do with the money. So it's basically a capital investment, as we call it. It's an investment in the long-term running of the business, which is through purchasing a pizza oven. All right, so now all the questions that you asked me in the chat box are very relevant, like what will be the money spent on, who is on your team, what kind of interest rate you had in mind. But the question is, where do I get all this information? So an important information source that we have is called the financial statements of a firm. And so these are written records that convey the business activities and the financial performance of a company. So the idea is, in order to make decisions, we need relevant information. And I want to walk you through a little bit about how the different aspects of a business work together so that you can understand how these information sources, which are financial statements, are relevant to us and what they really have to do with the bigger picture of finance. So I've made a little bit of an infographic here. And you know, we'll start off with, let's say, decision making, and then we'll come back to it. This is basically a cycle that happens through every point in time in a business. So we take certain decisions and then they're implemented in the business. So the implementation is done through the management team, through the marketing team, through HR, through other multiple facets that we have going on in a business. Sometimes it also includes the chief financial officer and other parts of finance, but usually it's like a really big team that's involved. So all these other degrees that you have done, that's where the implementation of decision comes in. And then these decisions have a financial impact on the firm. They actually are causing changes to occur in the firm. These can be good changes, these can be bad changes, but ultimately the firm is moving in a particular direction. And so that's basically the financial impact on the firm. Now, I want to make something very clear. When we talk about finance, we talk about decision making and not decision recording. That's the job of accounting. So I have a lot of people come up to me and say, "Oh, accounting and finance, same thing." Let me tell you, I have an undergrad in accounting and it's nowhere as interesting as finances. So there is definitely a huge distinction. When it comes to accounting, the idea is we're deciphering financial impact in accounting terms. So we have these regulators such as Financial Accounting Standard Board. We have the SEC, which is Securities and Exchange Commission, and all of these larger bodies that give us rules and regulations on how information is supposed to be interpreted and recorded. So, for example, think about it in Anna's context. If we're making financial statements for each year and someone threw a business party for, let's say, for Christmas, they threw this large party where Anna did the catering, and it was on 25th of December. They got a lot of teriyaki tacos, they got a lot of these, burgers, but they didn't pay for it by the end of the period. And we're making these financial statements. It's December 31st, and you have this large bill that is owing to this company, and it's about, let's say, $10,000, for example. So FASB, SEC, General Accepted Accounting Principles, which is called GAAP, these are all the rules and regulations that are going to tell you how this is supposed to record it. Like, does this matter? Is this part of our financial statement? Do we say that we made a sale or not? So that's what accounting is. It's deciphering what happened, how to interpret it, and how to record it. Because at the end of the day, we want a good record of what's going on with the financial statements. Now, the financial statements are always reflecting what has happened in the past, right? And so we need to have clear rules in order to understand A, what are the basis of these recordings? B, we want to make them consistent across firms so that we are actually comparing apples to apples when we're deciding between two firms or when we're doing any sort of analysis. So that's really accounting's job. So after they decipher what's really going on in there, we also have the creation of those financial statements. So now we're having these updated statements that are coming out each year, even each quarter. That's what accounting is associated with. So when I teach my accounting course, I tell them, you know what, we have the easy job because all the decisions have been made. We just have to interpret what's going on. And then when I teach finance, I'm like, we're doing the fun part because we're taking the decisions and everyone's just, recording what we've done. So that's what the basic difference is. And then after we have these decisions that have been made, after these financial statements that have been made, we have something called auditing, where we're assessing the validity of what has been reported. So auditing is the next step forward. Basically, we're saying we've made these financial statements and we have a third party investigating whether the claims that we have made are true or not. So that's the job of auditing. And then finance steps in. So financial statements then get reconfigured for understanding the implications of what has happened in the past, for making assumptions going on into the future, for understanding what the implications of particular decisions were, and how we should keep changing our assumptions to better adapt to what's happening. And so that's a very big part of finance. So we have like ratio analysis. I remember we had one of the RSVPs talk about ratio analysis. So that's definitely part of finance because we're trying to understand, okay, how is the company doing in relation to itself? How is the company doing in relationship to others? So that's what we use ratio analysis for. This is also the step where we're also looking not just at the quantitative part of financial statements, we also look at the qualitative part. So if you guys have seen annual reports of any company, you'll see that there's a lot of gibberish going on there, which is, to be honest, it's not to be ignored. It's actually meant to be read, but it's usually so much boilerplate that it's really difficult to understand what's happening. However, that is an important part of finance. It's data collection, data dissemination, and data application to make future decisions. And now we use this information for taking decisions. And once we've taken these decisions, this cycle starts all over again. So we're now implementing them, they're having an impact on the firm, and then we're going back to the recording and then back to this whole cycle. So finance is very integral to the interpretation of accounting. So without a basis of understanding what financial statements are, what the basis of creating them is, what the idea behind different numbers and different principles is, it's very difficult to take the correct decisions. So definitely I would, we'll spend a little bit of time looking at financial statements today, but before you can even go into finance, I would suggest picking up a book on just basic accounting. What is a balance sheet? What is an income statement? What are they trying to show us? What have been the changes over time in these financial statements? How they, change in their reporting, in their recording, because it really is something that's very fluid. So remember, financial statements, these have been there since 100, 150 years. But over time, as we see fraud, as we see the potential for miscommunication, as we see the potential for just inflation of our financial statements, as in making us seem better without actually doing anything fraudulent. So that's called earnings management. What has happened is these financial statements have evolved. So for example, if you guys, you weren't alive in the Great Depression, I hope not, but the Great Depression, one of the biggest reasons that the Great Depression happened was because financial statements were prepared with different principles in mind at that point. And we have this whole concept of book value and market values. And now, because we have had this huge collapse of the market in 1938, we changed up that system. And now we're implementing these principles that allow a better reflection. And to be honest, a more pessimistic reflection of how the firm is doing. So we can talk about that if we have some time left at the end of this session. But the idea is financial statements are changing over time. And it's a very good knowledge base to have before you just jump into finance. So I hope this diagram, it's a little rustic, but I hope it kind of gives you an idea of where you fit into the firm and where finance kind of fits into the firm. All right. So let's just talk for a quick minute about these financial statements that I've mentioned. So we have a balance sheet, we have an income statement, a cash flow statement, and a statement of shareholder equity. So the balance sheet basically tells you what the business owns, how much it owes, and how much money was put into the business. So for example, for Anna's tacos, we would have it owns, let's say, the refrigeration system, the ovens, not the pizza oven, just maybe a normal oven, the tables and the chairs, what it owes. So they're like other people that can have lent money for the business. Yes, Nathan, I will put up a copy of this PowerPoint. I'm glad to hear that you find this useful. So that's what the balance sheet is, right? So what you own, what you owe, and what money has been put in. So for example, we have Anna that must have invested some money into the business herself, maybe even Anna's partners, even her parents. We always go to our parents like that. So I'm pretty sure Anna's parents put some money in there. And then we have an income statement. So we're going to focus on the income statement today. I'm going to walk you through a little bit more about the income statement. But the basic idea of an income statement is how much was the sale? So basically, how much did I make from this revenue? And how much was the expenditure associated with generating those sales? What is my income that's left over? And what did I do with it? I'll tell you more in detail about that in just a second. And then we have a cash flow statement. So something that's very important that I'd like to point out is when we talk about money, when we talk about like the flow of funds, we confuse cash and credit a lot. And so this is something that we have to understand intrinsically are different things. So remember the catering party that I talked to you about recently? So we said that it was a Christmas party and they hadn't paid Anna yet. So now in that case, there had been no actual cash that came into a business. However, according to generally accepted accounting principles, a sale had actually been made because there has been that fulfillment of that contract, right? And there's a high expectation that the firm is going to pay them back. So because of that, it's being reflected in the income statement as a sales. However, no cash is actually exchanged hands. So what the cash flow statement does is it basically looks at how the cash is moving in that firm, the actual money coming in and out. So the balance sheet and the income statement are prepared on accrual basis, which is basically cash does not have had changed hands, but there has been a contract that has been fulfilled and there's an expectation of cash coming in. The cash flow statement shows what the true cash movement has been. And then the last statement that's very important is the statement of shareholders' equity. And the statement of shareholders' equity is basically, think of it like an album, right? So it's saying over time what has happened. How much money have we put into the business again? And this is how much money we've taken out and things like that. So basically the relationship between the investor or the owner of the firm and the firm itself. So think of it like the checks and balances, right? So over the years, we've put back in the retained earnings, we have taken out some dividends. All of that is going to be in your statement of shareholders' equity. But since we only have 45 minutes, we'll focus on just the income statement for today. So as I said, the income statement basically shows us four things. What was the firm's income and what have the customers basically put in during the period? What were the firm's expenses in generating the above revenue? So what the expenses were. Did the income exceed the expenses needed to generate this income? So basically we're saying we have this restaurant. We generated from the sales of our tacos, our burgers, we generated $100,000 for the year. But in order to generate that $100,000, I have had to incur certain expenses. I needed the wait staff. I needed to pay rent for the location. I needed to probably pay insurance. I needed to pay, let's say I have a liquor license. I have to pay the liquor license fee. I've had to do all these other expenses in order to generate that $100,000. So after incorporating all of those expenses, did I actually make money or not? Now, remember, this is the income statement. This is not the cash flow statement. So we're not really concerned about actual cash going in and out. We're just accumulating for that period all the money that we're expecting to have come in and all the money that we have expected to remove from that. So that's the net profit or net loss. And also this includes taxes. And if you're in San Diego, in California, taxes are a nightmare. So definitely that's something we really have to consider when we're going into business. And last, what are you doing with this income for that period? So either you're putting it back into the business in retained earnings forms, or it's being distributed to investors. So the income statement is the summary for a period about sales, expenses, the net profit or loss, and what is being done with that net profit or loss. Right. So now what we're going to do is I'm going to show you, so I have a past and a projected net income. So Anna's Teriyaki Tacos has come up with what their projected income would be and what their actual income was in the last 2 years. So they're saying, if we take on this loan in order to get this pizza oven, we expect our projected income to increase in the next few years. And so now we're using this information. So we're going to be their potential lenders. So the questions that I have for you is, what are some of the observations that you're making from these income statements? What do you feel are the questions you would ask, or what are the assumptions that you would doubt or say, okay, are these realistic or not? What information are you picking up from these income statements in order to decide whether to lend them the money or not? So I'll leave it open to the chat box and I'll see what comes in. What is the project based on? Okay.
Priya, I think he's saying, what is the projection based on?
What is the projection based on? Right. So the projection is based on the assumption that they get this loan for $10,000 to purchase a pizza oven. Remember? So Anna's standing here in 2020, and she's providing us these projected financial statements saying, if I get this loan, this is what I assume my company is going to do with this money, and this is how I expect the net sales, the cost of goods sold, and gross profit are going to be based on. All right, income. Okay, is marketing budget enough? Okay. I'm going to start typing this out somewhere. Okay. Is the marketing budget enough to grow sales according to the assumption? So we're having questions about the advertising budget. That's a good point, right? because we're introducing a new product and there's a potential that our new advertising budget isn't enough. That's a very valid point. Where are your wages classified? So we have wages down here under part of expenses, because remember, cost of goods sold in this case is just the tomatoes and the avocados and the flour and all of that that's used in order to create these products. So it's not the labor, it's just the raw material. So that's part of cost of goods sold. Okay. Anything else? Has market research been done on the interest? That's a very valid point. Okay, so are they only taking 1,200 or 1,300 per year? Where are we getting the 1,200 from? So let's assume that the wages are for like the wait staff. So what the owner takes out is basically the dividends. Net income for 2021 is 14,000. Is that after the repayment of the loan? If not, is that enough to continue to finance the business? That's a very good point, right? So the idea is the repayment of a loan is not put into the income statement. What we do put into the income statement is the repayment of interest. Now, have you noticed that the interest went up from $50 to $175? So they're assuming, Anna's assumption is that she will be paying $125 in interest per year. That's a big assumption to make, right? So she's expecting to get a loan very cheap. And then how pizzas would it make, how many pizzas would it take to make that projected income, right? Is there even demand for that? So I remember one, Ken asked, has market research been done on the interest for Fusion Pizza? That's a very valid point, and it relates to what William has said. Can staff and infrastructure of restaurants support that? That's also a very good point. So I think she has projected for higher wages to maybe get a chef in that specializes in using the pizza oven. But yeah, maybe she hasn't she hasn't projected well enough for this new demand for the people that would be working the pizza oven. What do you guys think of depreciation? Do you have a, just with a yes or no, would you understand what depreciation is? So depreciation is an accounting term, which basically says we have this fixed asset and we're using it over time, but instead of, we can't just expense the whole thing, because we're not just going to say, oh, in 2010 we have this large $10,000 oven. What we're going to do is, based on how long we're using it and how much we're using it, we're going to apportion its cost over time. So basically, from 2020 to 2021 onwards, the increase has only been $300. So the new oven is being depreciated by $300 a year. And so the idea is that high enough depreciation? Are you undervaluing the usage of this oven? Because think about it, the higher your depreciation is, the lower your eventual net income could be. So this could be a point of contention. Janet is asking, where's the loan reflected? The loan gets reflected in your balance sheet, right? So the idea is the balance sheet is what you own, what you owe, and what is invested into the firm. So the balance sheet of this firm is going to go from having a certain amount of assets to more assets to reflect this new oven, because that's an asset that the firm has. But it's also going to have higher liabilities because it's going to be owing for that oven. So that's where that is reflected. And Nathan asked, like, the depreciation expense. Well, yes, so this is what we just talked about. So these are the kind of observations that we're making, right? So we're saying that advertising budget might not be enough. What is your projection of pizzas based on? You're saying that your income from 2019 to 2022 is nearly going to double. Are you really saying that your pizza sales are going to be that successful? So you have all these contentions, and these are very valid points. So that's a very valid point. So these are the concerns that we have. Now, if we have decided, okay, we have all these contentions, Anna has answered these questions. If you decide to lend Anna the money, how will you decide the interest rate and other terms of the loan? So if you've decided that Anna's investment is worth it, the numbers seem that, okay, it makes sense that we can get $70,000 in sales, we can have this advertising, everything seems rosy. Next, how do you decide what your compensation should be in order to actually lend this money? So what's going on in the chat? Consider the cost of capital, right? So Emily brought up the point of cost of capital. So the idea of cost of capital is the investment that is made into the firm, and basically the expectation about how well it will do and risk associated with that previously, right? What's going on with the business so far determines how we're going to price this loan in the future. So yes, so we're considering the previous cost at which Anna got her previous investments and even her previous loans. So what else? What else would you need in order to decide what the interest rate charge would be and the terms of the loan? So another example of terms of the loan would be how long this loan is going to be for. Is it a 1-year loan, a 5-year loan, a 10-year loan? Do you need collateral for this loan? Collateral as in, do you need her to pledge certain assets in the case that she is not able to repay her loan? So what other factors would you consider when you are deciding the interest rate or the reward you deserve for taking on this risk? Right, I'm still waiting up. No one? Her repayment history, very good idea, right? So Anna's credit, yes. So Brad is talking about current market rates. Christian is talking about Anna's credit, and Chandler is talking about her repayment history. Very valid point. So has she repaid her debts in the past? And now this is a very interesting point that Christian brought up actually, which says Anna's credit. And Anna runs a one-man business, which is called a sole proprietorship. Sole proprietorship is where there is no distinction between the person and the firm. And when that happens, really, it's called unlimited liability. Basically, if the business is unable to repay the loan, then Anna has to pay it. So yes, Anna's credit history is very important in this case. And then Nasser is saying, what is her liability? So yes, the current level of liability in the firm. If she already has taken on a lot of loans currently, then it's going to make it harder for her to take on more debt and pay it off. So that's also a very valid point. Do we have any other ideas about what other information we can take from this? Okay, her asset base, right? Because we want to understand, let's say we do require collateral, then exactly what can she sell it what can she sell off if she can't repay the loan? So Alicia talks about how much her revenue will be. So we've kind of discussed that in the income statement, but we can always ask her the assumptions that she has made to understand how much risk is involved. But one of the most important aspects when it comes to financial decision making is looking around, right? So the idea is, if we have other businesses, right, and no two businesses are comparable, but if we can look at other businesses, how much interest they're being charged, understand their risk profile, and compare that to Anna's, then we would be able to understand, okay, where really does the interest rate or the reward rate fall for Anna? So here I have a few examples. So we have City Tacos, which is a taco food truck. It has, no brick and mortar, and they're paying 13% interest rate. They're a relatively new business, so it's understandable why they'll be considered risky. And then we have King and Queen Cantina, which is a Mexican fusion restaurant. And so you would say that this is slightly more comparable to Anna's type of a business because it's also fusion. Then we have Dijamara, which is a very famous San Diego-based restaurant, and it recently got high praise from Michelin. So the idea is something like a Michelin validation is going to obviously lower the risk of the firm. So it makes sense that the interest rate associated with Dija Mara is lower than that of City Tacos and King and Queen Cantina. And then I know that we're in the land of really good Mexican food, so just mentioning Chipotle might be, you know, equivalent to a sin at this point, but I had to bring it in. I could not skip out on that. So Chipotle, for the rest of us that have been in other parts of the country where we don't get really good Mexican food, it's a large Mexican-based chain, and they charge they get like 5.5% interest rate. So you can see again, Chipotle has lower risk compared to Dija Mara because it's more spread out, it has a better following. And then we have the US Bank, where if you put in the money for, let's say, 2 years, you get 0.6% interest rate. And the US Treasury, if you purchase bonds from the government, they will pay you 0.16%. So notice that the US Treasury, which is the government, it's giving you the least interest rate. Because the government is assumed to never default or to never not be able to repay its debt, then it gives you the least reward for investing in them. So I'll leave it open up in the chat, and I'd like to hear from you guys between which two firms or which two organizations do you think Anna falls between? So is it City Tacos and King and Queen, or King and Queen and Dija Mara, or maybe around Chipotle? Where do you think would be a good place to kind of fit in the reward and the interest rate of a firm? Between King and Queen and Chipotle, okay? So it's kind of, we're going from between 5.5% to 9%. Between City Tacos and King and Queen, okay? So we're getting a lot of City Tacos and King and Queen. King and Queen and Dija Mara, City Tacos and King and Queen, okay? City Tacos. All right, so we're having, okay, between City and King. By the way, there's no correct answer to this. So if you were hoping for an A plus, unfortunately, you'll get it just for participation and attendance. But I think I really like, so a lot of people are saying that we're following somewhere between City Tacos and Dija Mara. And I think that's a very valid point, because the idea is we're still somewhat of a new business. We're not completely well established. So no, we do not have that much of a clout, but we're growing. So I think, yeah, between 6.5 to 13% would be definitely a very good range that we would go for charging Anna. So I think you guys have made a very good decision. So I'm just going to be concluding now, since we're at our 40-minute mark. And just to reiterate, what we did was really a financial practice, right? We looked at risks, we looked at what a potential reward would be, and then we made a financial decision. But you know, before I end this, I want you to have, I want to have two questions for you guys. First of all is, you know, now that we talked a little bit about financial statements and their importance, where is your role and work reflected in financial statements? So I want you to take that away with you, and to basically understand, okay, I am a marketing person. Yes, Nasser, I'll be sharing the PowerPoint. So basically, what is your role? Where is it reflected? So if you're a marketing person, then it's in the advertising expenses. If you are in charge of HR, then your work is being reflected in the wages. And the second question is, how do you contribute to the risk mitigation and reward creation for your firm? Because really, at the end of the day, it's the larger scheme of things is the firm wants to minimize its risk, right? So that we have better rewards, we have a better way of ascertaining funds for it. And at the same time, we also want to create something for the rest of society. So what is your role in the risk mitigation of the firm, the reward creation of the firm, and what can you do, you know, to make it even better? So that's really all that I have for you guys. You guys were wonderful, so engaging. So thank you for coming. I know that we had a few questions when you signed up. I will be reaching out to you and answering those questions as best as I can. And this is my email right here. If you guys want to reach out, if you have any more questions, I would love to answer them. Right.
Priya, thank you so much. And I really appreciate your offer to, respond to some of those questions by email.
Mhm.
I don't know if you have a couple more minutes, if anybody wants to unmute and ask you
Yeah,
a question as we're winding down, but
sure.
that's really nice. And then thank you also for your willingness to share the slides.
I
So
will send
I'll
the
be sure to,
updated version for you to share out. I updated it this morning, so I'll send you that up.
okay. So I'll be sure to follow up with everybody. Um, but thank you so much. We
Of
really appreciate
course,
it.
of
This
course.
was great. Learned a lot.
Thank you. So it looks like we don't have any questions for me. But I think, yeah, definitely we'll have the slides. We'll have the slides off to you. I think that's been one of the biggest concerns in the chat boxes. Will we get the slides or not? I promise you, you will get those slides. This is a great session, and I hope you understood how finance is really an all-encompassing field. It's not just about numbers. It's not just it's not a straightforward thing. It's very engaging, and you have to keep looking out into the world and not just within the firm itself to understand how to position yourself, how to do the best for it. So thank you
I,
for having
I,
me.
I love the way you sort of wove it into the story too. That was really helpful to kind of understand, Anna's business and how you had us all consider, the risks and different things involved with helping her grow her business. That was terrific. Thank you, Priya. Really appreciate it.
All right. Think we
Okay,
could.
well, bye everybody. And thank you for joining. We'll have two more in this series. And oh, let's see. Somebody said they accidentally got kicked out of so I'll be sure to give you the slides. But in any event, there's two more in the series. And so we hope that you'll join those. If you look at this thank you slide, you'll see more events coming up, industry networking, entrepreneurship, an alumni spotlight. Sparks Gallery is alumni owned. And please take a look at all of these and continue to join us. We really love to engage with our alumni and students in these ways. Thank you all. And thanks again, Priya.
All
Bye
right.
now.
Bye, everyone.